Okay, so we'll look at the technical perspective, and yes, I mean I do agree that there's a space over here for a market to be able to make a recovery because the market has been quite depressed, and we've seen quite a bit of weeks and months that the market has been really deteriorating because the global environment has been really very stiff in terms of showing us any prospective upsides, and so the technicals look like they're changing maybe just a little bit, but unfortunately the downtrends are still very much in place, and so we really have to be able to focus on what the current trend situation is and see if any other piece of mileage can actually be taken in here for the market to show this provisional rally that we're all really hoping for. So to be able to get a view of how difficult it has been for the markets, if you look at the slide that we have, you can see how the Philippines being down about 15% since the beginning of the year, and how it's fared against different markets across the world. And you can kind of get a sense that the Philippines was not the only situation showing bad movements here. You've had across the globe movements of heavy deterioration, particularly even in the MSCI EMF index, which was also quite down quite a bit. So we can see this area here, and we can see that this, including the S&P 500, the one in light blue, and then we even have Europe, German DAX also being down, even doing worse than the Philippines that you've had. And so we've seen quite a broad base. Now, in terms of the Philippines situation in Asia, you can also see that quite a number of Asian markets were lower. It was quite unfortunate, however, that the Philippines performed one of the worst. It was only bested by South Korea, because South Korea was down quite exorbitantly, almost 20% in its particular decline. And so we've seen a lot of downsides already in what we've looked at, and that's why we've managed to be able to look on that situation that the Philippines, perhaps the other markets, have been sold down quite ridiculously. Perhaps because, of course, the fears out of rising interest rates, inflation, the potential for recession to come inside, really to curb growth, is really hurting prices. And those risks still remain, but I would say that perhaps a little bit of diffusion has come, especially in recent days when we've seen the US particularly raise interest rates, and we'll talk about that in one of the charts that I have. So last time I spoke to you, I did an earlier mid-year outlook because when I felt that the market was attempting to be able to give and break next level of support, we had to be able to touch base with you to just tell you what's going on, and that we anticipated that the market could falter a bit more. And during that time, we were really looking at global markets doing the same, weakening. And we did see that US and Europe were also lower. Then we felt that, of course, yields were still on an upward path at that particular time. And as they started to do that, the Philippines started to play a catch-up game in terms of raising rates as well. So as April pointed out, I mean, a rising rate environment is not really very good for the equity market because it generates competition. That means if you would put your money in more safer instruments, especially those on fixed income, which is less risky, you could still get a viable yield as compared to the stock market, which can be more volatile. And we did see yields come in, but it seemed to have peaked sometime in mid-June. And in some places, we still have yet to see that, but that's something that we'll also look at in a little while. Currencies have also placed out to be quite a bit of pressure, because we've been also seeing conditions that showed quite a bit of volatility as well. Now, April pointed out that oil managed to be able to see some softening, and I think that was one of the positive things that we could see, especially in some of the areas like commodities and even wheat, as I'll show you later. Also managed to be able to wrestle from coming up to a previous high, and both of them have actually come down since. And so in terms of the Philippines, we talked about the potential correction into the Philippines. I was looking at something maybe towards 6,550 to 6,380. It kind of passed that a little bit. And I said the second level would be a range from about 6,220 to about 5,800. We haven't gone all the way to that downside, at least not of yet, and I hope we don't. But I was really anticipating that a potential fifth wave on an Elliott swing create that sell-off of which that we've also had to deal with. Now we'll have a look at it. The PSEi low was somewhere close to 6,050, and then we'll look at the technical condition as well in a little while. Let's start first with one of the biggest markets in the world and have a look at the situation. So being the S&P 500, I look at this first because this market tends to generate ripples towards other markets around the world. So we need to see where we are in this particular market and to see if this particular market can cause some other type of external fluctuations on our side. So what I see for the S&P 500 is we're seeing a major rally right now coming off a very exaggerated decline. And this particular decline, kind of was really offset in the last month or so. And as of yesterday, was still relatively in recovery mode. And I do hope that we can continue a little bit more, but we may have to anticipate some choppiness along the way after this last few days of a rally as well. Now, in this particular context, my expectation really is to see next resistance first at about 4,080, and hopefully later we can reach something a little higher, maybe between 4230 or maybe 4360. If you were to look at the chart, that would be maybe somewhere in this band over here if we can get lucky. If we can see the US do that and see more of that rebound type of situation, it should be able to help all our other markets try to do something of the same kind of maneuver as well. So this is key. If the US stops where it is right now or banks off and heads back down, I would feel that would put a struggle with everybody else. So I think this is a market that we have to continue to watch. Furthermore, looking into the short-term Elliott wave cycle of this particular market, the S&P 500, if you look at the chart here on the left side, it looks like we've gone through 5 waves of a corrective element a day, 1, 2, 3, 4, 5. And if we are in a bearish market, which I would have to attest that we are in, normally the Elliott wave is inverted. And so normally you get 5 waves on decline, and we have those 5 waves. And recently, we've seen a downtrend line break from that index. And this is the reason why we're seeing a much more viable rally than what we've seen so far. The rallies before were not really very, very big. And this time around, because of that downtrend line break, now we can see a little bit more upside activity, which I will now label first as an A wave. Now, remember, since we are inverting an Elliott wave, normally an ABC is in benefit normally of a down part of a market. But since you're coming from an inverted type of Elliott wave, you will see an ABC in favor of a rally. The A wave now being a rally wave, the B wave a corrective wave, a pullback, and then maybe a C wave later where it will complete the rally, end there, and then show another corrective maneuver all over again. Now, let's look at China as an example of what potentially the US could do. So in China, we've actually seen a earlier rally take place. So look at this, the A wave that China was actually able to do. This is the Shanghai index here on the right side. It too completed a 5-wave activity, 1, 2, 3, 4, 5. And after this last one, then we just see prices shoot up. If you notice, this part over here looks relatively similar to where the S&P is just recently coming from. So, we hope that we could see some extensions. It may not be as strong as this, but something like this is something we want to expect, and something that could normalize the movement of the Shanghai index in this case, and hopefully the same for the S&P 500. This is what April called a reversion to the mean. And what that means is she's just trying to normalize the decline from the extremely exaggerated in the downside and push it back to somewhere where the fundamentals are much more accommodating to that value. And the same thing to the S&P, and who knows, I hope that the same thing can happen to the Philippine market when we talk about that later. Now, when I was reviewing this thing into the S&P 500's Elliott wave, I had to be able to find out some way to see what were the analysts out in the global sense looking at the US and seeing, oh, what are they feeling with regards to this? Although I may not be a fundamentalist, I mean, I do listen to their opinions, especially the ones that seem to be more consistently correct. And this is one particular analyst that I follow a lot. This is from Liz Ann Saunders of Charles Schwab. I follow her very, very closely. And, it's very rare I would even hear this analyst become bearish. And this is one quote that I've got from her most recent report. And if I may just read it to you. The forward earnings estimates have started to crest, in other words, top. We are likely still in the early phases of a downgrade cycle, according to her. And stocks weakness thus far may have priced in some of the declines in the second quarter profits. But what matters more is how much companies see their bottom lines getting hit later this year, a risk that may be the driver of the next bout of weakness for stocks. Okay, so the reason I'd like to just introduce this is because they started to be able to introduce the concept that earnings growth in the US seems to have crested, and they wanted to see how much more of that slowdown might come in. We did hear April mention about the threat of a recession that may really come in. We don't know if it's going to be a hard type of landing or a soft type of landing. But one thing this analyst did reiterate is that she said that the way the profit growth seems to be tapering off seems to be mirroring what happened during the dot-com bubble in the US. And so what she did here, if you notice the chart first on the lower right side, she compared this red line that you see on top, and she superimposed it with 3 bear market samples. The second one you see in yellow or in gold is the dot-com bubble type of profit growth de-escalation. And because of that, it seems to be mirroring what's happening today in terms of profit growth in the US tapering. And the last 2 bear markets you see in the bottom are completely very different. And she put another piece of proof where she noticed that the revisions of 3-month earnings revisions in the US have really fallen down quite sharply since where they've come from. And so what she's just trying to say is, yes, we might see the market might make a recovery, but she says, hold your horses, and you might have to take this with a grain of salt, because let's look at the bigger picture and see whether this thing will bite us later on. Because we might see a relief rally now, but we might see some pressure add on when we see companies start reporting earnings maybe sometime in the second half, and see some softness there that might generate some sort of corrective volatility against the market. So I wanted to be able to see, again, compare what did the US market do during that dot-com bubble, and compare the S&P 500 and compare it to today's S&P 500 in today's scenario. So the chart that you see on top, I know it's a bit heavy in information, but if you could just follow me. So this was the bullish market that ended sometime in the late 2000s. And then you see that the market started to contract quite heavily during that time. And the dot-com bust was really a menacing type of situation, because it demolished the tech sector really quite robustly, and only a few tech companies survived this. And this is the reason why it probably took them 2.5 years to try to get out of that bearish stand. Now, we may not be in similar constraints, but again, it might be too early for me to even say that. But one thing I want to be able to point out is that the market did also correct into the S&P in today's situation. And in a technical situation, or a technical signal that came in, is what we call a death cross. Now, death cross is when we watch 2 moving averages, the 50-day EMA, or the 50-day moving average, and comparing it with a 200-day moving average. That's the green line you see here on top, and the 50-day is the blue line. Now, when that 50-day crosses below the 200-day moving average, that's normally taken as a bearish sign, and that's what they call a death cross. Now, when they say it's a death cross, that means shorter-term trends are crossing over longer-term trends and are putting downside pressure into that market. And until that reverses, until you see the opposite of that, which is known as a golden cross, golden because you now see that the 50 days crossing above the 200-day, like the way it did here, but did that 2.5 years later, that's the only time we really saw a more viable rally come out from the US market. In between that, we maintained a downward market, as you see right here. Rallies did come, and viable rallies at that, but it stopped pretty much short of the 200-day moving average, and it fell down again, then it rallied, stopped at the same or the downtrend lines, And then we just continue doing that until one day the market decides to turn. Now, I cannot tell you that it's going to take 2.5 years to do the same thing now. I hope it's much shorter. But the indicator we're looking for really is whether we could see the similar type of crossover, or what we see a golden cross somehow tell us that the worst is over and that we have a new upward trending situation coming back at that. So until that time comes, we should be looking at rallies to be temporary. If they rally back to the 200-day moving average or to the downtrend line, and they seem to have a hard time breaking above that, then we should be selling or lightening into those rally types first until the market can expose something more confident in terms of that trend situation or trend reversal condition that we can find. So looking at other different types of macroeconomic indications. Now, April said earlier that we did see some softening in some of the worrisome items already. Here's one of them. She mentioned bond yields have started to soften up. That's correct. If you notice what happened into the US, the 10-year government bond yield, we look at this particular indicator because it tends to show what the expectation for interest rates are. It's a little bit more advanced than actual raising of rates or lowering of rates. And so that's why we look at this first, because we'd like to see things in advance. And so far in the short term, we've seen it seem to be peaking after hitting highs of 3.4% or 3.5%. It now fell back down to something closer to 2.7% in recent days. And so that's good, because at least it shows that the threat for any aggressive rate movements moving upward has now softened or is now tapering. And that now gives more room that we could say perhaps the worst is over, like what April said. Right? Now, I'm using the word perhaps because we would like more time to be correct in making that particular type of assumption. If we were to look at the Philippine side, we have here on the right side the Philippine 10-year government bond. And just in a few days ago, we've seen an uptrend line break coming below 6.7% in terms of our 10-year yield and fall somewhere closer to 6.4. I heard earlier before I began today that rates could have been, this T-bill rate could, this treasury bond rate is something going closer to maybe 6.2 or 6.1%. So we'll verify that later. But again, that's a good sign because it shows you at least that there seems to be a wrestling down of any aggressive rate movements moving from where we are. And that could be the case, and putting explanation to what April said, people seem to be being in a hurry now to lock in buying their bonds because they want to make sure that the yields still are being kept at that high range. And as they buy more, of course, the bond price goes up, the yield of that particular bond goes down. And that's the reason why we'll probably be seeing a more aggressive move to buy bonds like she was talking about. But I really hope that that will depress now the situation on seeing a yield rate or an interest rate that might be a bit too messy into an upside. So these are slightly more bullish than where we've come from in the last month or so. And that could, again, contribute to that potential interim rally that we were looking at. Now, if you go back into the US and compare now the movement of the federal funds rate, because they've recently in the last few days just raised interest rates and they push it up another 75 basis points. And then that's this blue line you see here. And one thing you see that they're finally converging. So what you're seeing, this is the 10-year bond yield, the dotted line, and it's now meeting the actual interest rate values that the Fed fund push rates to. So it's telling you that the Fed rate is now where the market wanted it to be. Because for a time, you've seen that the yields were all the way up here and rates were all the way down here. And that was the mismatch that the market was kind of worried about, saying that there's no choice. Rates would probably have to go up there because that's where the market seems to be expecting. Now, with expectations now being hit, there's a possibility that perhaps we don't see too much aggressive rate movements anymore, and that maybe we could see something a bit more, maybe less aggressive, or hopefully something more on a sideways cast in terms of what interest rates can do. But remember, down the road is we still are watchful of what inflation is doing, because the US tagged on an inflation rate of 9.1%. And how do you stave this on based on what you're seeing with these types of rates? So we may need to see rates either pick up a little bit more or stay here a little bit longer to try to bring that growth level down so that it can contribute to the demand level softening and inflation eventually diffusing itself. And so these are the things that we still have to watch out for into a market. And that's why I'm still looking at the wait and see episode here. In terms of currencies, we did see some slight pullbacks into the US dollar in recent days as well. And I hope we can see more, because this has been the reason why the peso dollar rate has been very, very weak here. And so if we do see some more corrective adjustments into the dollar index, which I'm hoping can weaken. It's currently trading closer to about 106 on the index level. And if we can soften that to maybe somewhere 104 or maybe even 103, that could do wonders to be able to help a little bit more see corrective action in the peso dollar rate, which as you can see from this picture, went from 52.50 all the way up to a high band of about 56.5, and we need that to be able to recollect itself a bit more at a better support level for us. So I'm hoping that the US peso dollar rate can gravitate a little bit lower. In oil, and now we're seeing oil prices test major support somewhere closer to $94 per barrel. If we can break this support threshold, then we might be able to see oil back off a little bit more, maybe looking at something like 87.50, or again, if we're lucky, maybe something closer to $80. I'm sure the market would love that very much. But right now, I don't want to get ahead of myself. We're at major support. We need this to break in order to see those next level support targets. And if it doesn't break, then we'll probably see this consolidate a little bit more. Maybe the next rally could be somewhere closer to about maybe 105 or 110, maybe not go all the way back up to this. I think we've seen the high in oil already. And if you were to look at my example, which I presented last time in wheat, it looks kind of similar to the double top we've seen in oil, and then it just completely smashed itself on the downside after breaking two support sites. And so far it seems to be finding its next level of support closer to about maybe 760 or 750. And now maybe it might need to rally a little bit just to recompose itself from showing a very hefty decline or correction. But still very good that it's come off the major highs, and this would be a very helpful regards to softening the potential threat on inflation down the road. Now let's go into our market, and being the PSEi. Now, I guess my concern really in the PSEi is, although we've seen some rallies as well in the last few days, except today, we want to be able to make sure that we ground ourselves in our view here. Yes, there's a potential rally situation over here still, despite today's decline, but we want to see more evidence of that rally because we are currently still into a downtrend. If you look at the graph I have here, I still have two trend lines, downtrend lines that we still have to watch over. And the first one maybe being something closer to about 6,420. The next one is about 6,600. We still have to be able to break through this in order for us to escape the corrective clutches of this downtrend that we currently have. Now, I painted two scenarios here. The first one is the favorable one. We see like a little bit of a triangular pattern here breaking out topside, and I think we may have done that, but unfortunately today's pullback may have pushed us back into that pattern a little bit. But let's hope for, it's still looking more like this one than the less preferred scenario, which I want to see, which is this one where we see a new low. And again, until we can see those downtrend lines break, I cannot put this situation out completely. So we're currently in a tentative situation, so far looking a little better rather than worse. And I did put some resistance and support levels up here to tell you to watch so that we can get a better view of what can happen to the market. But so far, so good. It's only if this market breaks below maybe that 6,130 zone that I would get worried again. So let's try to be focused more on being a little bit optimistic in this shorter term period of time, maybe looking into the next few weeks. And hopefully we can get better signals in that particular period. Now, looking into the Elliott wave, the Philippine market, again, just like the US, I've seen 5 waves down, 1, 2, 3, 4, 5 into the short term. And here we are attempting to make a rally wave. Not as strong as the US so far because the downtrend line is still very much intact. But if it can push above that 6466 level, then we could very much be on that A wave type of recovery. And who knows, maybe we could even rebound all the way back up to the 200-day moving average, hopefully slightly higher. But again, I wanted to show you we do have a death cross. So again, that's where the 50-day moving average breaks below the 200-day moving average. The spreads between the two moving average are very wide. And to me, that's very concerning. And the reason is because whenever you have these two showing that type of wideness from each other, that tells you that the trend that it's showing you, in this case being a downtrend, is still very strong and lingering. And so that's why I'm a little bit more, I would say more cautiously optimistic, because we have to be able to see two things break before we can be very much optimistic from this situation. And so we have to take this one step at a time. We have to go through one major resistance and then another before we even can become, a little bit more aggressive. Until that time, I would still take the position as if you're trying to take a trade right now, I'll be looking to sell this on the way up as we come closer to those two resistance points. Second situation is I'm looking at the longer term picture into the Elliott wave, and I'm still counting that we've just come off a wave 4. So again, wave 1, wave 2, wave 3, wave 4. This is a longer term Elliott cycle. And it looks like we're in a 5th wave. Now, we may have just fallen a bit too sharp because we're at the presence of the previous low. Maybe we can have an interim rally, but I'm thinking down the road, this might turn down again. And I hope it doesn't retest the low, but if we can make a higher low and up, then that would be the better scenario to see. If we see this come back up and then head back down to this 6,100 level, that is something we don't want to see, because that could allow this 5th wave to continue downwards, and it's something that we could still hit that 5,800 level down the road. So we have to really be very nimble and watchful of these situations, because the technicals are not completely in our favor yet. They're only in favor of seeing an interim rally as of now. Now, another thing that's against us is net foreign flows. So if you can see this, this particular chart showing you all these red down bars, you see that means that we've been net foreign selling in the Philippines. And in recent periods, in the beginning, roughly mid-May, all the way up to 1 or 2 days ago, we've still seen net foreign flows heading out. And it didn't really matter. All these other indications you see below are just telling you, or just factoring in different changes in economic or political situations. But the view of the foreign side is just liquidating and liquidating and liquidating. So I guess they need more convincing. But one thing good about this that can come out down the road is that at least we know all this has been removed from the market, and that's just an X amount of shares that's less to be sold into our market, because it's changed hands, perhaps into stronger hands, and maybe like April said, going to their Filipino owner counterparts, because she did notice a lot of insider buying taking place already in quite a number of stocks. So maybe we need a little bit more of that to be able to rejuvenate the fact that we want to tighten supply, so that one day demand can come back and push the market higher. So in summary, we look at the global market, and we're still seeing what seems to be temporary rallies into the US and Europe. And keep in mind that this is because some of the headwinds, like, for example, the instigators to inflation, for example, whether it be oil prices or wheat prices or copper prices, as April pointed out, have started to come down. So we hope that's a leading indication that eventually we'll probably see a tapering off in terms of inflation. But again, we want to see whether that will be reflective into food prices, because if you've seen the Philippines, it still hasn't shown that in big quantitative terms just yet. Second, interest rates have bond yields seem to have met up already with the Fed's fund rate, and since that's where we expect rates to be, we hope that we don't see too heavy or aggressive rate hiking anymore from this point. Maybe from a 0.75 basis point situation, maybe it could just be 50, hopefully maybe even 25, maybe in 1 or 2 quarters down the road. So nothing so aggressive, and that's what we want to see. Remember, we cannot just turn things off right away, because it takes time to change a trend. Okay, so you don't get, from acceleration mode, you will not go zero right away. It takes time to taper off. and so will the market. And when the market's trying to turn around from a downtrend and one day into a rallying trend, it takes time. So from a downtrend, maybe it'll try to go up and down, a sideways trend first, show that volatility, and maybe one day show a turnaround. So please put this in your picture that it takes time to change a trend of a particular stock. Currency is the same. We may see a little bit an interim top coming onto the US dollar, and hopefully the same in the Peso-Dollar rate. And like I said, I hope we can recompose somewhere closer to 54.90 and 54.40. In commodities, oil is now testing the 94 support level, and I really hope that we can break that so that we can see some more downward adjustments, and this will help a lot as it can become a potential tailwind for us and help us sustain a little bit more of the interim rally that we have. If not, then we'll probably see oil prices move sideways between $94 and maybe between 105 and 110 being the high band. And in terms of the Philippine technicals, the PSE is also testing its support basics 136.50. We've held so far, and we've had a little bit of a recovery moment, although it was quite upsetting that we didn't see that continuation today. We hope it's a one-off, but I guess the market will be watching the US to see if it can lead us higher or whether it will stop and allow us to gyrate sideways first. So I am not going to completely remove the test of 6,100 or even a 5,800 that could come in later. But so far, we hope that the interim can hold, and who knows, maybe we can see a recovery closer to 6,450 first, then hopefully 6,600 to 6,868. And I think that will give you a much wider room to be able to trade as a potential rally. However, keep in mind, we are still in an extended decline, being so that we are watching for interim basis and for possible oversold situations that could allow prices to recover back to where they should be rather than an exaggerated decline. This is what we mean a rally towards a reversion of the mean. And if you decide to take new positions in this, as you take your chance in seeing that this rally will manifest more, look to be lightening this. So we'd like to say that this will be more of a tactical position rather than a long-term position, at least for the active investor or the traders. This is because we still have to be able to deal with a lot of headwinds. We're not out of the woods. So if you're taking a position here that's added to your current, you're looking to just take a short-term position, take some profits, and make what we can as this pocket of opportunity. Maybe we can sell it towards resistance zones level 1 or resistance zones level 2. If you want, you can split your position, maybe 30–50% in the first level, and then the rest coming towards the second level of resistance. And also keep your eye on oversold rebounds. I mean, this is the stage where they can happen. But again, these could be brief rallies that come in. So pretty much what I was saying in number 1 and number 2, just take advantage of them now that it's here, because we've been quite depressed for a while. So hopefully we can see a little bit more from this activity. In terms of looking at the different sectors, I looked viably at which particular sectors seem to be leading into the rally mode. And these pictures you see as of for yesterday. And so far, the strongest seem to be coming from the commercial index, the conglomerates, and of course, the mining sector. However, it's quite unfortunate that the mining and oil sub-index heavily weighted on semi-rara. And that's the reason why you're seeing this kind of formation. If it were just all the other mining companies, it would look much more deteriorating. And so take this with a grain of salt. This is really primarily because of the movement of semi-rara, and that's the reason why it's managed to hold sideways so far. So maybe not so much on this, and be very selective. And then, of course, as a tentative sectors for recovery, we do have the financial services and the property index, this being the weakest in terms of the property. So I think as a strategy, I will only look at maybe the top 2 or top 3 in terms of those that are pushing these sectors higher. Don't be too broad-based in the latter. Be very choosy in this last 3, and maybe you can choose 2 or 3 more if you have the capability into the commercial and holdings index, because they're obviously leading because they're showing more durability. But again, I'd like you remember we're still in a bearish market, so do not run after prices. Okay, wait for prices to come back down. Let them show pullback before you start picking some of these issues or these favorites under this particular type of sub-indices. Now, I show this also pretty much when I do this type of analysis. but this particular thing houses all the index stocks. And this shows you the comparative movement of the index stocks compared to the index itself. And we break it down into quadrants. We have a leading quadrant, we have improving, then we have, of course, the lagging and the weakening quadrant that you see here. And so what happens in this situation, this kind of turns this way, all right? It turns this way clockwise. And so you probably want to watch for issues that are in the leading or improving quadrants and see whether there are potentials for them. Remember, just because it's there doesn't mean you automatically buy them. You have to look at it there and now say, does the technicals go into each chart and look at them and see whether are they viably making reversal patterns, breaking down trend lines, or making consolidation patterns that are about to break out, or are they just continuously sliding down? Like if you were to look on the left side of this chart on the bottom, you still have Ali, Megaworld, AGI, and Converge down there. And so you still have to be very careful of that. And I think look what happened to Converge today. It's still kind of weak. So again, there's a reason why they're staying weak. Until we can see more stickiness to their demand situation, we have to be careful. Now, this is my personal stake in terms of how I would look at the technical strategy for each of the index stocks. So I classify them into 4 areas: either a hold or a buy, a wait or a pullback or breakout, wait for a bottoming approach, or maybe a sell or sell into resistance. So for example, if I were to look at Ayala Core, it's still very much in a downward price channel. So in this particular situation, I would wait for a bottoming situation to happen in terms of Ayala Core. In terms of, for example, ASEN, I could say it could be a hold, or it could still, if you want to wait for a pullback or a breakout, if it's starting to show a little bit of a pattern, I'd rather not be too aggressive because it's just recently made a recovery. So maybe not so much buy more, but maybe you can hold the position, but just be watchful for it because it's climbed up a bit and you want it to be able to react if you're looking to be able to add into a position. So another example, let's say, for example, if you were to look at a stock like Monde. Now, Monde is into a big wide area pattern, and it's recently bounced off the base of its pattern. And there's a reason why I could put it under a buy because it's in a ranged buy mode. However, since it's in a range, I would be looking also to sell it when it were to rally back into a resistance area. So look at this guide that I have. At least it's your shortcut guide more where you can see what my opinion is about each of these index stocks. And then look at the graphs itself so that you can kind of get a measurement of why I'm saying so. And if you see like especially a sell in resistance, that means perhaps it's still locked into a range or into a price channel. And this is the reason why you probably want to downplay your aggressiveness into this stock. And of course, as the market as a whole has not really shown you that substantial type of a breakout of any meaningful conditions. We're seeing an interim rally only for the meantime. So what I would do is I introduce this particular technical guides to you, because I guess the question people would ask me right now, if we're in a bearish market, is there any opportunity to make money here? And so many people would argue, especially technicians, say, isn't this counter trend trading because the trend's going against us, it's going down. Why should I be buying a market that's going down? True, and I agree with that particular philosophy, but not all the time inside a downtrend that will just continuously fall and fall and fall. There are moments where sometimes in a downtrend that an exaggerated situation is taking place, or in this particular situation, it could be falling in the lower end of a particular range that it has already shown you before, and that there's a potential for it to make a recovery. So I'll present 5 different trade openings that you can use, even if the market's going down, where you can do some degree of trading activity. But mind you, again, remember, we're going against a trend, so I wouldn't want you to be all out aggressive in this particular stance. You have to take this as a tactical trade. Maybe you can allow just a little bit of money to do this, not a very aggressive amount, just so you can make some money into the interim while we're seeing especially some major rallies into some of these stocks. So the 5 trade openings I would watch for first would be something called a range trade of a down channel. So to give an perspective here, if you look at GT cap, you can clearly see that the price channel has drawn out, the descending one. And so what it does is every time it falls somewhere in the lower band of this range where you see this blue line, this is where you would look to buy when you see a rebound off it. and then you sell it when it comes closer to resistance, either from here, or if it can't, where you see it seems to be having a hard time, then you take some profits there, then wait for prices to pull back down to this blue line, see if it holds, if it rebounds, then you can go ahead and buy your stock back. Other issues that are looking something of this sort or showing this kind of price channels are issues like Metrobank, MPI, Manila Water, Nickel Asia, Pure Gold, RCR, Philrip, and of course Robinsons. So this is Robinson Street and then Robinson's Land here in the bottom. Another tactic you can also look is you can also do some range trading from those issues that seem to be showing a bit more viable strength. So for example, instead of showing you a downward price channel, they're actually building they're building a sideways range. So in this particular case, let's have a look at Union Bank as an example. It's been going down to a downtrend. The downtrend line has broken here in the last rally. And look what it's doing now. It's building a rectangular pattern. Now, keep in mind, a lot of issues out there is still faltering. Well, this one at least seems to be solidifying and showing you a sideways base. So that's good. At least it's showing you demand seems to be picking up and trying to make a stand. It's not telling you it's going up yet. In order for that to happen, we need prices to break out of this upper band that you see here. So we do range trading within this sideways range. That means when it rebounds off the low range, this blue line you see here, you buy it. And if it comes off the previous high off, then you can take some profits there. Or if you want, you can hold some of your positions if you're thinking that it might break out. And if it does break out, you can add back into your position after that. So you can do either a new buy there, or you can add back to the position that you have. So and some of the issues also in this would be Aboitiz Power, Cebu Air, DMC, Monde, SM Prime, Security Bank, and SPNet. Now, some of these issues have actually broken out, like Aboitiz Power, DMC. So they're a bit on the heftier side already, so it's getting a bit more aggressive, at least for those. But the others are still within a trading band, so you can continue to be able to do the range trading from within. So the next one I have is what we call an oversold rebound that will generate what we call a mean reversion. I know that mean reversion sounds a little bit foggy, but let me just simply show you what it means. So let's have a look at Ayala Land as an example. Your downtrend line that you see here, I want you to interpret this as the line where the price should be as it's going down, because that is the leading line telling you where the selling pressure is as prices are heading downwards. But every once in a while, as stocks continue to deteriorate, they sometimes accelerate. There could be some piece of news that could come out. It could be an aberration in emotional strain that could come out. So instead of just following this downwards this way, all of a sudden they accelerate downwards, and they do so emphatically. So much so that it triggers an oversold condition in your RSI. When we say oversold in your RSI, this is a RSI reading that goes below 30% or more. So in this particular case, you can clearly see in your RSI reading, we did hit a below 30% zone. And after that, there was a recovery made into Ayala Land. And so some of you bargain hunters who are trying your hand, don't just buy them anywhere here. Wait for an oversold reading to come out, and especially these popular type of issues, which especially an index stock, which normally people have to buy, and then take advantage of them during that period of weakness, especially when an oversold reading. And look what happens. You buy them somewhere closer to the low, then it recovers back. And when you come back to the mean, where your trend line is or your major resistance points are, then you lighten back or you sell your stock position there. Remember, you have to do that because you're still into a downtrend. Okay, we're only taking a tactical short-term position here. So when we're saying a short-term position, it could last a few weeks, maybe 1 or 2 months. We're not looking anything longer than that, at least for now. Again, recently, Ayala Land fell all the way back down here closer to 2250, again registering an oversold condition. And again, here we are trying to make a recovery path. And hopefully, maybe into the next 1 or 2 or 3 weeks, maybe we could even see an attempt to be able to make a recovery back to the high band of its downtrend line. So if you tried buying some here, remember what you're supposed to do when prices come back on the upper boundary. You're supposed to start lightening or maybe selling the tactical position that you bought. Okay, some of the issues showing oversold conditions, Converge, Globe, and Felix Mining as well. Then we look for W, or what we call higher low bases. When we say W, we mean a support retest. So in this particular case, let's highlight Aboitiz Equity Ventures. So we have a downtrend, first rally, then look what happens. The rally fizzles out and goes all the way back down to where the previous low came from, and it did not break, and then solidified, broke another short-term downtrend line or even major resistance before seeing what happened in the last few days. I know it eased off a little bit today, but it doesn't nullify the breakout that it managed to do. So this is what we call a W base, because if you were to draw this like the letter W, first swing, rally, retest of the low, and then a push back up. So this is what we call a reversal signal. So this is a bit in advance in what the rest of the market's doing. What's nice about what Aboitiz Equity Ventures is doing is it's a bit leading towards the index now. And it's nice to see these pockets of activity because we need more leaders like this to show substance and to give us more meaning that the potential interim rally can manifest more. And so as we see these support retests come in, this is a viable attempt for some people to do some buybacks. And for you, for a potential trade, as soon as you see the support rebounds of the previous low, you can buy some and maybe add when prices break off resistance, and seems to be you're doing well today. Other issues that could be doing something similar, we have ABS, Aboitiz Power, BDO, Jollibee, Macro Asia, Mega World, Robinsons, SM, Wilcon. If you notice, I have Robinsons land here also in the previous example, because it's quite possible that in a stock formation, you could have it do 2 or 3 formations at the same time, and that adds to more credence that we could see more viable recovery from that. And finally, typical rallies from downtrend lines. Now, to me, this is very important. Now, downtrend lines are what's holding our market down. Our index is still below a downtrend line. But you can see there are already some issues, like we pointed out, Aboitiz Equity Ventures is one of them. Here we have ASEN. Here's a major downtrend line for ASEN breaking out over here. And so that tells you already a more viable rally, and that's the reason why from this price, it's now all the way back up here. And hopefully we can see if it can last a little bit longer, but right now it's winding, so it will have to make a new decision of where prices are right now. So what happens is perhaps a new rally channel can form, and maybe you can draw your own lines after we see a downtrend line break. Normally after a downtrend line break, normally an area pattern comes. So I think what could happen later in ASEN is that you could probably see it rally maybe closer to 9, maybe just off 9 pesos, and then maybe back off and then prepare for a more consolidating type of movement first for ASEN. But so far, so good. I don't think that will probably be coming back down to where it's come from. So let's just look for a higher low opportunities and pullbacks for ASEN as a potential. Some issues that are breaking their trend lines already: AGI, OHC, DNL, ICTS, IMI, JG Summit, ARIT, Robinsons Retail, PLDT, and URC. So again, that can tell us perhaps for these stocks, maybe the worst is over. But remember, a breakout from a downtrend doesn't mean an uptrend. It may just go sideways first in a wide band. So that's why I'm telling you, as it comes closer to major resistance, take some profits, lighten first, and then wait for the pullback. You see higher lows, that becomes your next opportunity to buy your stock. So I hope that I've managed to be able to present some technical guides for you that can store some potential trade activity despite having some weakness still into the market.